I've been processing a lot of information, and I think I'm ready to condense it and present it. I want to talk about just the SPY. I'm going to pull up that chart right now and we'll get right into this analysis. So if you've been watching my channel, you know that I've been following this ascending broadening wedge. You're going to see that outlined here with these yellow lines. And there's two trend line here and this dashed line. This is the medial line. And this is a good area of resistance. And I've been using the RSI to help inform where the tops and bottoms of these trend lines should go. And this is the best fit I have for the pattern. So what we saw in early this year, as the year began, we saw the price began to fall of the SPY. And the medial line there acting as support. And as the price fell through, there was a breakout and then a nice congestion formed here. This would be the beginning of a double bottom, but recently we've seen the price drop further than that, so I'm considering this just to be now a level of horizontal congestion. There's some support and resistance through here. Any point within the height of these candles can act as support or resistance. And the price did, from this level, bounce and pull back up into the pattern, failing to even reach that medial line you can see here, and formed a double top. I'm gonna go ahead and zoom in. And here you can see that this double top, these candles do not look overly bullish. This particularly looks somewhat like a hammer, but being at the top of a price trend and being on low volume, I wasn't overly optimistic that we'd see a continuation of this run. The price did come down and find support along the bottom of the ascending broadening wedge. As you can see here, the tails of these candles almost all perfectly touch this line at this point. And we did here see another bounce, but the price failed to break out above the last minor high, very bearish signal. And as the price continued to fall, it broke out again, pulled back up, failed to pull back into the pattern, and then rejected down. And as the price fell below this low here, this confirmed the double bottom, and the price began to move towards that target, which was, or that double top target, which was at $419. And you can see that did happen in a single day, and then the price bounced up and up. And this looks incredibly enthusiastic. And in the face of all the geopolitical tension and the reality of the state of inflation, I think that this is reckless. This is not, I don't think that the situation economically or geopolitically has improved at all. And so I'm not feeling great about this. This looks really good. This is a very strong bullish pattern, by the way, to have the opening price so far below and then rush up into the range of the previous candle like this. This is very bullish, and I wasn't surprised at all to see another very bullish day. This is incredible stuff. It looks so good. And I can understand the optimism, right? People are going to be hoping for the price to break back up into this pattern, which is up here at 447. And it is possible to see that happen before we see a continuation of the downtrend. And I think that's probably what's most likely. I am keeping an eye out, though, for a Black Swan event or some sort of catalyst to send the price back down. And what we could see instead is this wicked pipe top pattern. And what that essentially would be is, let me scooch this over. I'd be looking for two candles about the same height as these two, but extending downward. And it would just essentially completely reverse all of these gains. And that seems more likely to me given the way things are escalating geopolitically. I'm gonna drop a blank chart really quick and we'll do some trend line analysis study. Okay, I already have something up here. Let me just pull this down. Clear drawing set. Yeah. Okay, zoom back out. So let's talk about uptrends and downtrends. I'm gonna pull another year up here so we get the COVID crash. Okay, and I'm gonna be using that COVID crash as my first reference point. So here we go. From the bottom to the top, and then not overriding the price. As you can see, there's some overriding here. So this is gonna be my defining low probably. Nope, one of these lows. There it is. This is the uptrend that we saw following the COVID crash. I'm gonna go ahead and just, whoops, try to make this green here. You might see the box, you might not see the box where I'm selecting the options. Okay, so pretty clean breakout at that point, right? Now, if we were to take a price target from this trend line, we'd be looking for the greatest distance from the trend line itself to the price, and I think that occurs right about here. I'm just gonna draw a line down to that, and what do we have? We have, drop it, drop it. Thank you. What's that say? Minus $95. That's a lot. So I'm going to take that $95. I'm going to apply it to the breakout price. All right. And this is the breakout target for breaking that uptrend. It's 366. So this is the most bearish target that I'm putting down on the board here. But given that 366, given that we saw that double top pattern price target reached, I'm pretty confident in putting this one down too, even in the face of this incredible bounce, right? Like that is an incredible bounce. This though does not, this looks really good, and but I honestly think it's just irrational response to complacency. Nothing bad can happen. Stonks only go up. Like that's not true. Let's go ahead and pull this up to right here. Okay. So I'm gonna just. This is not a precise target. I'll calculate the price target more precisely when and if the price should actually reach that level. So I'm gonna now zoom in a little bit and get rid of this measure. There we go. And let's draw the recent downtrend. So the high is at 479, and we're gonna go to the lowest low and then not overwrite the price at all, right? Which brings us right here. This is the actual downtrend, and it's nowhere near even being tested yet. You can see the price could still rise another, well, let's look, 437, another 10, 11, 12 dollars even before even testing this primary downtrend. So the price has a long way to go before we can say, hey, the price has recovered or the markets in general are starting to come back. I think we're a long way off from that. Let's go ahead and look at the RSI. Maybe we can get some indication of where this resistance line should be. We can see that the RSI, I'm gonna go ahead and pull this up a little bit. The RSI at this point is pretty high, and so I'm just dragging my cursor from left to right, or I guess you see it probably like this. But I'm actually looking down here. I have 59 here, and it drops, and then it comes up and bounces down right there, which is very near, as you can see. I'm gonna go ahead and drop a yellow line, or a arrow right there. We saw it dip down, and the RSI at that point was at 52. Moving on, we can see a near touch here, and the RSI was low, 52. Okay. And then we saw that double top form, and the RSI was at about the same level there as well. Okay, so as the price moves down, the RSI drops as well, and then it didn't quite reach that oversold level. And so maybe we have some big divergence here in the RSI and the price, as the price sets a new low between here and here and sets a higher low here and here. So what does that mean? Well, we're going to be looking for the RSI to pass this crucial level of about 52 to 53 before we say, hey, we're officially in a breakout pattern, bullish divergence playing out. And it's possible this bullish divergence will just lead it to the pattern itself up here. So currently the RSI is sitting at around 45, and just another 10-point rise, or 5 to 10-point rise in the RSI would most likely lead to another touch point up here. So that's why I say I think that I can imagine the price moving higher again before coming down. Now, if there is a particularly bad event or economic news, and next week could be a very bad week news-wise, we have all sorts of economic data coming out, I think we could see this downtrend to continue. And maybe this is actually not the high. Maybe the high is actually back here. We gotta clean that up. That's, whew. You can see this downtrend appears to have been broken. I'm gonna zoom in on it really carefully. We'll zoom in on time frame, try to get a good read on that. But that looks pretty bullish, right? So at this point, we're gonna be looking for the price to return and test the breakout price or this trend line before closing again higher, waiting for a new intermediate high to confirm that breakout. Zooming in on the 15-minute, we're gonna get in here and have a close look. So you can see the price rose, hit oversold there. All right, I'm gonna keep going with my arrows. You can see overbought as the price is reaching the trend line, not oversold. I always get those two. I say that. I flip-flop a lot on that terminology. It's hard. Okay. And let's see, we don't see the RSI reach that same overbought level until it's encountering the trend line again here. And what happens here is we can see that the price began to spin on this line, diving above, dipping below, diving above, dipping below. And we can even zoom in on the 1 day and get a really good look at what that looked like. Yeah, you can see it. Look at how the price is interacting with that trend line. And when I draw these trend lines on a large time frame and I can zoom in, zoom in, zoom in, zoom in, zoom in, and it makes sense as I zoom in, I know it's a good trend line. So it looks like there was a fling to the upside here, but it's not super decisive. It's pretty wishy-washy. I mean, this could really go either way. Market open on Monday. So I think that while here it might look like a breakout, I think that there's still more work to be done by the bulls to actually solidify this move. And then once they break this trend line, this accelerated trend line as I call it, they're going to need to break through this trend line as well. So I don't think that the SPY is out of the woods yet, and I think a fall down to even 366 could be incoming, and that would be a significant drop. But I think that some events and market data could justify a move like that. I'm gonna go ahead and zoom out onto the weekly time frame, see what it looks like out there, and I'm gonna go ahead and just delete all this. So let's see here, drawings, remove drawings, clear drawing set, yes. Okay, so here we go. Wow, this though on the weekly, this is an incredibly bullish candle. This is so bullish. And to see that happening at 43, this is probably a good spot for it to turn around. This is a fantastic opportunity for bullish reversal. And on the weekly time frame, I'm probably going to be looking for a breakout above that level, somewhere around 450. And then ultimately passing above 458 to confirm a double bottom. I mean, the lows of these two candles here on the weekly time frame are kind of far apart for a double bottom. But honestly, it looks like it could be playing out like that. Next week is going to be a big signal week. Whether or not we see the SPY encounter that trend line and break out to the upside on the daily or reject and turn down is going to be very, very important. And we'll see it on the weekly time frame, I believe. So, and that would suggest that the price probably needs another month or two before really confirming whether or not we found the bottom. I mean, if we saw a euphoric rise, that would be one thing, but I just don't see that being in the cards. I'm more likely to see a dump down. So I'm looking at implied volatility now here at the bottom. You can see it's been pretty flat and it is relatively high. Volume seems to be above the 30-week average as the price lowers, and that makes sense too. That tail though, that looks really good. This is a hell of a bullish hammer reversal. Gonna be looking for a close above this prior week though before we can confirm it, right? So what's the SPY doing? The SPY looks like it's trying to push for a bullish reversal. However, I don't think that the market fundamentals would support that breakout. So going into the next week, what I'm looking for is either rejection of the current downtrend, the short-term downtrend, or a breakout. And then once that level is determined, either a slide to 366 or a test of that primary downtrend that's a little higher. So not out of the woods yet, and I would just be cautious and temper optimism. When I say that I don't think that there's a fundamental basis for a recovery in the broader equities markets, I'm referring to the increasing cost to produce goods and the inflation that's being passed down to the consumer and the overall financial state of the American consumer as well. I want to start by pulling up a graphic from the Bureau of Labor Statistics on PPI. And what you're going to see here are a couple of bars, and they're just showing what the 12-month percentage change is for the producer price index, or the cost it takes to make goods. And you're going to see that the level of inflation here, or the cost to produce goods, has risen drastically, over 12%, reaching 13%. This is quite high, and this isn't exactly what we're seeing consumers pay yet. And you're going to see services has not risen as much. And I've been listening to Kathy Woods, and she's been identifying that this just has to do with the way the consumer is spending, moving away from services and into goods, which makes sense given the pandemic and the way that we've been trying to social distance, etc. So this, I think, would indicate that there is further cost to be passed down to the consumer in the future. That is to say, the inflationary trend is not changing. I don't think I see that here. The next picture I want to pull up is about CPI. This is the Consumer Price Index, and this is what, as an American consumer, we're used to looking at the most. This is the 12-month percentage change, and there are some selected categories broken down. So this is again the 12-month percentage change. We're going to start on the left side. You see this bar chart. We have all items above 5%, somewhere in between the 6 and 7 range. That's not so bad. I mean, it is bad. It's a lot. It's way over the Fed's target of 2%. But given that the producer price index is much higher than that, not all of the costs or not all of the result of inflation and price rise has been actualized yet. You move over to food and it's similar. It's pretty high, but it's not all that high. But what we see is a huge spike in the cost of energy. Huge, over 25%. This is incredible. And I think that this is going to be a big deal in the future, in the very short to near term future. I'll get into this a little bit more when I start to talk geopolitics with Russia, Ukraine, and China. And you're going to see another category here on this chart called all items less food and energy. As you can see, that's the lowest one. So what I'm seeing here is that CPI is not as high as PPI, i.e. the consumer isn't yet paying for the total increase in the cost of goods. Yet, and I say yet, and that's implying an inflationary trend to continue, for costs to be passed down to the consumer still. And I think that's a big deal because in the short term, this has been okay. During the pandemic, people were able to save money as they weren't commuting, as they cut costs in their discretionary spending. We saw that in the shrinking of the economy in certain sectors like leisure, travel, restaurant, the food industry. We saw a lot of contraction there. All that money was being saved by the consumer and now is being spent. And as that spending continues, the savings that Americans have are beginning to diminish. And I'm going to pull up a couple more pictures here. I want to show the savings rate and also the gross savings. And I'll pull those up. And what you're going to see is that there were 2 points where gross savings were the highest, and they've been declining since. And also, you're going to notice that the percentage rate is beginning to decrease. And I think what that is the liquidity that was built up during the pandemic and that was also generated through stimulus becoming exhausted. And I think when we're looking at the PPI and the CPI, what we're seeing is that the cost to produce goods is going up, but those costs aren't reaching the consumer yet. I think the realization is that a lot of inventory that was built up during the pandemic and during the supply chain issues is being released, and so there hasn't been a lot of demand to produce new goods. But once the demand to produce new goods goes up, then the prices that the consumers are paying will also go up. And so we're going to see that inflation will rise and consumers will save less. And I believe that, as Meet Kevin puts it, aggregate demand will shrink, and we're going to see a drastic shift in the economic state of the U.S. It goes into the stimulus that the Fed pumped out being exhausted, and I don't think that it's going to be as bad as in 2008. I do think, though, that there will be fewer jobs posted and that we're going to see the demand for labor shrink, and that's going to have a negative impact on wages, which isn't good because at the same time we're going to have this inflation. So I think the US consumer is about to get squeezed, and I'm not entirely sure how that's going to look long term. But I think in the short term we're going to see a continued fall in the equities markets. A lot of valuations are too high, and Munger said that, and I'm seeing that in the headline news now. I've been thinking for a long time that the equities markets have been overvalued and they need a correction, and we've been watching the money supply become greatly inflated. Maybe I'll pull up a chart here to show the M1 or the M2 money supply, and just note, I have it on my my whiteboard over here. This is just notes. Like, this is just what I look at. All right, I don't really plan on showing this a lot, but I've been looking at the capital asset pricing model a lot, and just trying to figure out what's going on with the dollar strength and the money supply, interest rates, the relative price of gold. And I think the big takeaway here is when we had the TARP Act after the financial crisis of 2008, $700 billion of stimulus were just created and thrown to the market. And what we saw gold do over the next few years was increase by 250%. Currently, we've recently seen the CARES Act and it's $2.2 trillion of inflation hitting the markets. They've been covering gold. And I think that there's going to be another big cycle in gold, much like we saw after 2008 when the money supply was drastically increased. And I think despite the deflationary pressures, I think gold is going to continue to rise. And I'm not even sure what that means for dollar strength. I think there's going to be a new dynamic introduced. I've been watching Russia and China increase their gold purchasing over the last few years, and it's been really intriguing to see a lot of repatriation of gold, a lot of gold being added to central bank reserves. I think that there's a big future for gold here. So I've also been noticing that in the short term that the Fed has been buying bonds while bond rates have been dropping. We've been watching the yield curve drop. To me, it feels like the Federal Reserve is basically the last entity really supporting the markets, and when it begins to taper that stimulus and begins to draw back, I think that we're going to see a recession ensue, and that's just going to have to be the reality. So that's my whiteboard, and I'll edit in those pictures. So I think overall, the American consumer is in a really good spot currently, paying down their debts, increasing the amount of debt they have, but also they're running out of savings. And as inflation continues and the consumer has less discretionary spending, that will inevitably lead to poor earnings moving forward into 2022. So perhaps we see a year-long bear market ensue, and we could really see the price of these index funds drop in that time. That's why I don't think that we're going to see this big bullish bounce and reversal in the US equity stock market. And that's just outside of the geopolitical landscape, which I think is going to serve as a catalyst for a lot of this.